Good morning, everyone. Welcome to 24/7. My name is Niharika Balia, and I'm with you with the area of AFM. Am I audible as well as visible? Okay, am I audible clearly, everyone? We'll be continuing further with the topic of 60 days, 60 classes. Right now, we are left with hardly 30 days for your examination. Okay, so let's continue further with this particular topic. Today we'll be talking about the concept of 60 days, 60 classes further. Here comes the first question, everyone. It says that opening stock is equal to 1 lakh and the closing stock is rupees 60,000, and then we have purchases worth rupees 50,000, and then the GP is worth 10%. So in this case, they have given us a specific amount of 10% and they're asking about what is the GP. So this is a practical question. Okay. So in this case, what would be the correct answer? If I have to specify the concept there, it is based upon this area that first is opening stock is given. Opening stock is worth rupees 1 lakh, right? The purchases that we are making, the purchases is worth rupees 50,000. Then the closing stock is worth rupees 60,000, right? So you can use the formula for the area of cost of goods sold. In terms of the total cost, it would be 1 lakh 50 minus 60. Cost of goods sold is 90, and the question says that the GP is 10% of sales. That means if the sales is 100, then this cost is 10% less. So the cost is at 90% today. So what would be the value of 100%? It would be rupees 1 lakh all in all. So in this case, if the sales is of 1 lakh rupees, then the amount that we are receiving in this case is 1 lakh minus cost, that is 90,000. The remaining and the balancing figure is C, that is we are looking forward towards the GP, right? That is answer is 10,000. Next question. If I talk about the provision for provident fund, it comes under what? Long term provisions, then trade payables, or other current liabilities, or none of the options. If I talk about the topic there, provision for provident fund is basically a provision that we make in terms of our this is something we make in terms of our employees. That is also a long term one. So it is there for the employees now. So if it is there for the employees, it is long-term provision, trade payables, other current liabilities, or none. See, the point is, in this case, it's a provision. That means we are anticipating that we might have to pay further. This would be treated as a long-term provision, right? It's A. Next point is marketable securities appear in the company's balance sheet under the subhead of current investments, non-current investments, intangible assets, or short-term loans and advances. If I talk about the marketable securities, these are those securities which are held today for a little period of time, and then we'll be selling them off and making arrangements for our liquidity without facing any major changes in it. So it would be current investments, non-current investments, intangible assets, or short-term loans and advances. In terms of this particular topic, marketable securities appear in the company's balance sheet under the area of Basically, since it is going to be sold at any point of time during this particular year itself, it is going to be a part of current investments. But yes, if you remember the particular topic now, we have talked about cash flow statement as well. In terms of cash flow statement, it is a part of cash and cash equivalents. It is a part of cash and cash equivalents. Next point, for the calculation of cash flow from operating activities, payments and receipts shown in P&L are converted into payments and receipts actually in cash by eliminating non-cash revenue from the revenue earned and non-cash expenses from expenses incurred, the non-cash revenue from the revenue earned or non-cash expenses from expenses in or none of the above. When you're looking forward towards CFS and they are asking you about the payments and receipts shown in P&L that are converted into payments and receipts, then what do we eliminate in this case, everyone? See, whatever we do not want any of the non-cash things, right? So whatever we'll be looking forward towards this area is we'll be removing the non-cash expenses because non-cash expenses, the first one is depreciation. Now, if I talk about the basic area of depreciation or amortization of goodwill, both of these, this is not money that we are giving to anybody, isn't it? Are we giving this money to anyone? No. This is something that is there. If I'm using my phone, I'm losing its value over the period of time. The usage is there. So depreciation or amortization is there. So this particular scenario would be covered under the area of non-cash expenses in terms of the expenses incurred. So it is non-cash revenue from the revenue earned and non-cash expenses from the expenses incurred. So it is basically a both of these things are there in terms of expenses and even in terms of revenue, which does not belong to our business at all. So that is will be non-cash and non-operating is the exact point when we talk about the CFS there. In terms of CFS now, it is non-cash plus non-operating. Which of the following is not concerned with financing activity, everyone? The sale of non-current investments, loan taken from bank, issue of securities or increase in security premium. Which of the following is not concerned with the financing activity? Okay. Now, which of the following is not concerned with the financing activity? Sale of non-current investments, loan taken from bank, issue of equity shares, or increase in security premium. See, the point is, if I take a particular loan, this is based upon the fact that I am trying to take money from the other people and then I get finances for the business. And then, in terms of equity shares being issued, that is also a part of it. And the next point that comes is increase in the security premium. All these last three areas is where we are trying to increase our capital, while in terms of the normal working it would be called sale of non-current investments. Okay? So when we talk about the sale of non-current investments, that's because this particular area is investing activity. Whenever we sell a long-term asset, then it is always covered under non-current investments. The non-current investments are basically part of investing activities. Investing means the first is operating, second is investing, last is financing. So the odd man out was the portion that was regarding investing. Next question, the statement of cash flow clarifies that cash flow according to operating and non-operating, inflow and outflow, investing and non-operating, or operating, investing and financing. See, one thing is true that this particular concept is based upon inflow and outflow. But that's not the only thing on which the cash flow statement is based upon. In terms of this area, it is based upon inflow and outflow, that is regarding the movement of cash. But when we talk about the overall types of activities that it defines, it is basically operating, investing, as well as financing activity. Next point, in which of the cost of the following methods of equity capital is computed by dividing the dividend by market price per share or net proceeds per share? Price earning ratio, adjusted PE ratio, or adjusted dividend method, or dividend yield method? In which of the following the method of equity is computed by dividend? The dividend by market price. Just look at the question. It is saying that the first of all we'll find the dividend and divide it by the market price. That is dividend divided by the market price per equity share. We'll find it out and we'll divide it. This particular method is called the dividend yield method. What is the yield that we are making in terms of the dividend that we are paying to the people? Now, this particular thing, if this particular yield rate is higher, then the shareholders will be happy. Otherwise, they might complain about the working that is happening with them, right? Okay. Now, the next point. In terms of this, the cost of capital may be defined as weighted average cost of all debts, then rate of return expected by equity shareholders, average IRR, or minimum return that the firm should earn. Cost of capital is weighted average. See, the cost of capital is the amount or that we are incurring in terms of receiving the capital. So, see, the point is if I'm getting capital, then there's a cost of it. It is basically said that there's a myth there that the equity share capital will cost less because they are the owners of the organization. Now, what problem they'll cause? But if you'll increase more and more equity, the shareholding, then the first point that arises is their needs would arise. They would want more and more dividend, and they will always be comparing themselves with the debenture holders as well as the preference shareholders. While their working would go totally different, but still they would be looking forward to it. So the equity cost of capital earlier was felt that it was not very, but you know the cost of debt in terms of equity is quite high as compared to debts. In terms of debts, you get tax benefit, that is you get the tax shield. So, and at the same time you are retaining your decision making power as well. That is what we look forward to it. So the cost of capital may be defined as weighted average cost of all debts, rate of return, IRR, or minimum rate of return. In this case, the correct answer is minimum rate of return that the firm should earn. Now, the next point is regarding CAPM model. We have talked about CAPM model in the previous particular class in terms of whatever this model is. So, just a recheck of this topic. In order to find out the cost of equity, we're just trying to find the cost of equity under CAPM. Following is not required: beta of the stock, market rate of return, market rate of equity or risk free, rate of interest. in terms of CAPM model, that is capital asset pricing model, then in this case it is basically the formula of this particular way of finding the return is risk free rate plus beta, then we have market rate minus the RF, right? So in this case, is which one is not required? See, market rate is required, then even the beta is important, in even the risk free rate of return is important, but what we do not need is the market price of the equity shares. This is not required. This might be required in terms of PE ratio, in terms of EPS and MPS, or finding the dividend yield, but not in CAPM model. Under CAPM model, it's all about the rate of returns, not the amounts. So the market price per share is something that they do not need in this particular area. Holders' wealth is equal to the number of shares owned or current stock price per share, or number of shares owned multiplied by current stock price per share. Oh, the same question is there. The points are same. So in this case, whatever you take, it's all the same. Number of shares multiplied by current stock price. Whatever the current stock price is going on, that is what will multiply. Last question has 3 points that are being repetitive, but rest the question is correct. So in this case, this is where I end my particular session. But before I end it, I hope you remember that you are left with a very limited time, and this is the time which you need to utilize to the best possible level. And how do we utilize it? What you can do is you can check out our website for further details, or have you downloaded the app is the next question. If you haven't, then why are you losing up on the best features in this particular app, which can be used to study efficiently? Because let's talk about it, you are all working and then it becomes difficult to study if you're not planning in a better way and utilizing each and every break that you get. So it is basically JIB and CIB examination. You can go into the area of JIB and CIB Kamaha pack. Currently double validity is going on. You buy one particular batch and then you will be getting it in terms of the double, right? Double the amount there. You can take up the JIB Kamaha pack or JIB and CIB Kamaha pack. Now, what is the difference? In terms of the JIB Kamaha pack, you will have only and only JIB examination covered. So in this case, what can you do? You will have both the batches, that is English medium as well as the bilingual. Both the batches are opened up for you. Along with that, you will get 1 year of validity, and in this area, you will also get the test series in it, in there, as well as the power pack batch, revision batch, or any specific batch that will be coming up is all covered in this area. That means for both bilingual as well as medium, excuse me. So you will have not only the MCQs, not only the topics, but each and every class would be there available for you. Whatever previous batches which have just ended, just based upon the new syllabus, will also be considered in this area. So do not let this opportunity go away, because at this point of time, this particular Mahapack is costing at 714.78, 7149.78. What you can do is you can use the code Y541 and you can apply it, and here you will get a discount of 80%, and this would cost you 6499.80, a very low price. Basically, you're not even paying more than 600 in terms of your annual, in terms of per month area, if we talk about it, because annually it is 6,499 or 6,500 altogether. So if you're looking forward to it, then kindly hurry up, because the double validity is only for a limited period of time, and you can utilize it to the fullest in terms of your preparation, right? So if you're preparing for this examination, then kindly go ahead and check it out in our website or in our app for further details. This was JIB Kamaha pack. Along with this, we also have CIB Kamaha pack, JIB and CIB Kamaha pack. Rather, if I have to be very clear about that particular topic. So in this case, you can check it out, right? So if you're preparing for it, then kindly go ahead and check it out. I'll be meeting you in the next class at the same time. Thank you, everyone.